Hello, can you hear me? Hello? Hello, can you hear me? Hello? Hello? Hello, can you hear me? Okay, okay, it's fine now. Hello? Yeah, I think it's fine
Hello,
now.
Mr. Moshood, I can hear you well. I'm very sorry, the network is kind of breaking. Can you hear me
Oh,
now?
okay. Yeah, I can hear you. I can hear you. Fantastic. Okay. All right. All right. All right. Yeah. Okay.
I
Yeah.
don't talk.
Yeah.
I'll count that. You break everything down. Thank you so much, sir, for the time.
All right.
That time.
So
I really
I'm
appreciate you. Thank you so
starting
much, Mr.
now.
Moshood.
All right. So I'm starting now. Yeah. So let's just get into it. All right. So yeah, today we're going to be talking about how to grow and manage your wealth in 2025 and beyond. Right. So first thing first, I hope you have a notebook or a jotter with you, because most of the things I'm going to be saying are not going to be on the slides, but then the slides are there to, the slides are there to guide you and to just give you a description of what we're talking about, right? So let's move on. My name is Moshood Folarin. I am a chartered accountant, and I am a learner, just like you. Thank you for being here. Thank you for you know making up time to be here. So let's just get to it. The slides. Okay. Okay. I chart. Okay. So I'm trying to. Oh, what's wrong with this slide? Okay. Yeah. So we're going to talk about building your wealth in 2025 and beyond. Now the outline. So it's this the session is in two parts, right? We're talking about the wealth formula, active income versus passive income. We're talking about this webinar is moving by itself. I don't know why it is moving by itself. I don't know why. These slides are moving by themselves. Okay. Okay. Yeah. So these are the outlines. Now let's get into it. Can we remove the yes? Okay. Yeah. Yeah. So yeah, this session is divided into two parts. So this is the first part of the session. After that, we're going to take a break, just a short break, to watch a short video, to further illustrate what we're talking about. Then the second part, we fire off from there. And after that, we're going to do our question and answer. So let's start. This webinar is basically just for educational purpose, and it should not be quoted out of context, right? The the analysis, the slides you're gonna be seeing, they are my views, basically based on my research and my own analysis, and the way I view things. So if you want to, because we're gonna be talking about finance, and finance is a very it's a broad thing, especially personal finance. So depending on the context, you would have to, seek professional guidance before you can start, you know, investing, because this webinar is primarily about investing. But before we get into investing, we're still going to do some breakdown, right? So this is just a disclaimer to let you do your research before you do any investment. Do your own research analysis. All right. So now that is out of the way, let's move on. So, what is wealth? We're talking about building wealth in 2025. So, what is wealth? We have various definitions of wealth, but so far, this is the one that I see, like the one I feel it's just captures everything. This is talking about accumulating financial assets that gives you long-term security and financial independence, such that you do not have to rely on a paycheck, that is a salary or a wage. You're accumulating financial assets such that they are funding your lifestyle, making money while sleeping, in essence. That's what we're talking about. Now, this wealth we're talking about here is financial wealth, because in the later session, we'll be talking about the categories of wealth. But here, we're just talking about financial wealth. We're saying the degree to which you are wealthy is all about your ability to accumulate financial wealth assets such that you are able to, fund your lifestyle. You don't have to rely on any paycheck or rely on anybody. You can do anything you want, basically. That's what we're saying here about being wealthy, right? Now, we've all heard about the richest man in the world, Bill Gates, and Elon Musk, and different persons, Dangote, as the case here in Nigeria. We have him as the richest black man in the world. So how is he rich? What makes him so rich? So I just brings out I brought out a formula, just something we can work with, something you can use to understand how wealthy a person is or how wealthy you are as a person. So what is the formula for calculating wealth? Is it simply your total asset minus your total liabilities? That's it. What are assets? Assets are things that you own. All the things you own minus all the things that you owe, which are liabilities. Or things that you own, like car, rent, sorry, your assets, your physical possession. And it's not only physical assets. You know, we could talk about investments, your cash, they're all assets. Liability is talking about your things you incur as a liability, like rents, and all that. So when you want to calculate your wealth, your net worth, you're seeing all your total assets minus all your total liabilities. That's what we are talking about. Now, we have an equation here. This is an equation I sort of derived, right? It talks about financial management principle. It's basically about personal finance, how to manage your finance. On the left side, you can say income minus expenses equal to savings plus investment. Your incomes, we all know what incomes are. Incomes are things that come to you as a cash flow, e.g., your salary, your wages, money from your side hustles. And expenses are, things you spend money on: bill, groceries, food, rent. Then we see the difference between your income and your expense is what you're gonna be using to do your savings. Your the difference between your income and your expenses, the difference is what you're gonna be using to do your savings and your investment. What What do we mean by that? This is talking about how you can manage your wealth. This personal financial management, sort of like an equation. It just shows the relationship between how you manage your income with your expenses and why you have to save and invest for future reasons, for future purposes. So the difference between your expenses and your income is otherwise known as your net income. That is when all your inflows, the money that comes to you, are more than your expenses. That's an inflow. That's your net income. So what are you supposed to do with this net income? You're supposed to save, invest with those things. Now, how do you save and how do you invest? We're going to talk about that. You save by putting your money in in an asset or in an account such that it will grow over time. We're talking about at the rate of 12%. Now, this rate I'm talking about, they are peculiar to Nigeria. So if you're watching this from another country, you just have to keep that in context. What I'm talking about is peculiar to the Nigeria microeconomic environment. Okay. So when we say savings, putting your money into savings, why do you have to save? You save for emergency purposes only. You do not save for any other thing, for emergency purposes only. And experts advise that you should save for at least 3 months of your living expenses should be saved in an emergency fund. Where are you supposed to save it? You save it in a high yield interest saving account. Where can you get an high yield interest saving account? You can get them um on Piggyvest, on Cowrywise. Of course, we're still going to mention those. We're going to see a list of those platforms too, but it's important that you save for rainy days. Why do we say you should invest in an emergency for emergency purpose? Because anything can happen, right? Anything can happen. So in 2025, you want to make sure that you already have an emergency fund before you can start investing, right? One of the primary purpose of this webinar is to teach financial literacy. This is why we are doing this, nothing more, nothing less. Okay, so now we've looked at the equation and we saw that income comes first. So let's quickly delve into income. What are the types of income? We have active income and passive income. Right? We said income are those things that come in, right? Come in as a cash flow, e.g. your salary, you know, money from your side also and all that. But we still have them divided into two types: active income and passive income. Active income are those income you make from your direct involvement and effort. That means you actively trade your time for money. That's active income. Once you stop working, it doesn't come in. The money stops coming in. That is what we mean by active income. Now, a passive income is an income that comes in regardless of whether you put your time or not. Initially, you're gonna do some analysis and all that. But once you set it up, you don't have to be there. The money continues to come in. And that is one of the reasons why we are doing this session. Okay. Now, passive income, example of a passive income is dividend from stocks, royalties, rental income. I'm going to delve more on stocks and other investment types later on in the course of the session. But now, I just want you to know that there are two types of income: the active income and the passive income. Okay. Now, we want to talk about how do you even make money, right? Still on income, because I want to pick all of them one by one, all those variables. We said the financial management, the equation for financial management is your income minus your expenses. The difference between your income and your expenses is what you're going to use to save and invest. So now we're looking at income. We've talked about types of income, which is the active and the passive income. Now we're talking about how do you even make this income? How do you make this money? Okay, so there is a law called the law of compensation. The law of compensation is a universal law. What is a universal law? A universal law that there are laws that work for you or against you, regardless of your age, gender, religion, race, color, and all that. They work just like your law of gravity, right? whatever goes up must come down. So the law of compensation also work in that direction. So, what is the law of compensation stating? It's only stating that you will always be compensated for your effort and contributions in life in proportion to three things: the need for what you do, the ability to do it, and the difficulty in replacing you. This law is also called the law of prosperity. And, the first time I heard about this law was just my mind was just blown. That was in 2019 or 2020, thereabouts. It's really amazing. The amount of money you earn is in direct proportion to three things: the need for what you do, the ability to do it, the difficulty there is in replacing you. What do I mean by the need for what you do? Is there a need for what you're doing? Is there a need for your skills, your products? The greater the need, the higher the potential for your compensation. Does that make sense? Right. Then the second key thing you need to know is your ability to do that thing. Are you very good at what you're doing? That's your skills. Are you very good at it? If you are very good at what you're doing, your value increases in the marketplace. And the third one is the difficulty in replacing you. If you can just take care of the first two factors, the third one, you have no issue with the third one. It just follows suit straight up. If there is a great need for what you do and you are very good at doing it, automatically there will be difficulty in replacing you. That's just it. And that means your stock goes up. That means your price goes up, your value goes up. This law of compensation is deeply rooted in personal growth, personal development. It is directly tied. That is why we say economy is personal. The economy that affects everybody is not what affects you, because you are the one in charge. It is directly tied to your personal growth. If at all you don't get anything out of this section, the law of compensation is very important. Let's just take a look at someone, let's say in the movie industry, Funke Akindele, for example. Funke Akindele is a Nollywood actor, producer, director. Yeah, we all know her. Okay, is there a need for what Funke Akindele is doing? Is there a need for people to watch movie in December? Yes, there is a need. People want to flex in December. People want to spend money. People want to unwind. People want to enjoy themselves in December. People want to just, watch movie, have fun. Is there a need for people to watch movie? There's a great need for people to watch movie all over Nigeria, all over the world in December. There's a great need. Ability to do it. Is Funka really good at, you know, directing movie, producing movie, marketing movies, is she good at what she's doing? Oh yes, she's very good at, acting, bringing out diverse cast, in her movies, Is she difficult to replace? Oh yes, she's very difficult to. She has been, smashing the box office back to back for like 2-3 years now. So it is directly tied to her personal growth, self improvement. She's always willing to do more. She's always doing more. That's why her stock goes up. And money is always, it's not small money that she's getting paid. So that's one of the reasons why I think you should, look into this law of compensation and see how you can use it in your life, to make money. So now let's move to the next slide. All right, the active income sources. We said there are two types of income: the active and the passive income. You have paid employment, freelancing, entrepreneurship. Paid employment, you those that work 9 to 5. Freelancing, you're talking about those that work for different companies, working from home. You have a digital skills, you have skills that are quite that you can negotiate with in the marketplace. These are you get money. Entrepreneurship, we're talking about business owners, people that have businesses. You know, all of these three here, you are directly trading your time, your effort, and your energy to make money. These are the active income sources. Now, okay, these are the active income sources. Now, let's go to this quadrant. This is the cash flow quadrant. It's talking about it's in line with what we're discussing. I even had to include it because it is mind blowing actually. It is mind blowing. So what do we mean by the cash flow quadrant? The cash flow quadrant was discovered by Robert Kiyosaki. You know, the guy is he wrote Rich Dad Poor Dad, right? And he's one of he's a millionaire. I think he's a billionaire self. So he propounded this, and it's it's amazing actually. So the quadrant consists of four individuals in the societies, right? We have the employee, that's the E, we have the self-employed, we have the business owner, and we have the investors. Now, on the left, we have employee and self-employed. On the right, you have the business owner and the investors. So what is it talking about? So as an employee in the society, the major mindset of an average employee is that you have a job, I have a job, and I want job security. The mindset is just pay me my money and I'll be going. Give me a job. Be paying me every month. That's the average mindset of an employee. Now the self-employed is someone who said, no, I don't want to work for anybody, I want to work for myself. That's a business owner, your typical small business owners, you see them everywhere. And the big B stands for the big business owners. We're talking about the big companies, the limited companies and the PLCs. These ones they said, I cannot work. Oh. What I will do, I will not do this work directly because they work, or they work indirectly. I cannot do this work directly. What I will do is I'm going to create a system that will work for me. Then I will lead the system. That is what the business owners are talking about. Now the investors are saying, I cannot work. Instead, my money is going to work for me. Now, if you look at the left part of the quadrant, the employee and the self-employed, these people, they have to trade their time to make money. While the business owner and the investors, or they don't have to trade their time to make money. They just have to, you know, they have a system. The business owner has a system to make money for him, while the investor have money to make money for him. So, and another interesting thing about this quadrant is the employer. Hello, you can't hear me. Oh, can you can you hear me now? Please confirm if you can hear me. Hello. Okay. Please confirm if you can hear me. Can you hear me now? Can you hear me now? Okay. Just a minute. Please, I need someone to confirm if you can hear me before I continue. Hello. Okay, I think I know what to do. Let me just check it from my end here. Can you hear me? Can you hear me? Okay, I think it's fine now. Okay, yeah. So, can you hear me? Okay, I think it's fine now. Okay, yeah. So, moving on now, the employee, the cash flow quadrant. Yeah, I was talking about the mindsets of each each person in the quadrant. We said the employee is all about making money for himself, just do work, let me be an employee. Then we have the self-employed saying, I want to be an independent person. I don't want to work for anybody. I want to do my own business myself. And the business owner is saying, I'm going to create a system that works for me. Investor is saying, oh, my money is going to work for me. And that's what we're going to, and that's what an investor does basically. Okay. Then, now the interesting thing about this is that, just a minute. Yes. Interesting thing about this quadrant is very important you get it. Is the more you're successful on the left side, the more you're successful on the left side of the quadrant, the less time you have for yourself. Let me take that again. The more successful you are on the left quadrant, I'm talking about an employee and a self-employed person, the less time you have for yourself. Let's look at an employee. If an employee is very good at his job, he does his job perfectly, he's very good, he's excellent and all that, and he gets a promotion. The promotion is getting is more responsibility. More responsibility means that he's going to have less time for himself, which means he's going to be trading his time for money. Now, for the self-employed, we are saying if you have more success, you are still going to be tied to the job, to the business. For example, a bakery owner. Previously, the bakery owner was getting 5 orders per week, right? Then suddenly he got a big contract. He's now supplying 15 orders per week. Of course, we will count that as a success, right? But then he has to produce more. He has to trade more time to sell those things, to produce those things and sell those things. He has to engage more, in order to have more money. So basically, the more successful you are as an employee or as a self-employed person, the less time you have for yourself. While as a business owner, I'm talking about the big companies, you have a system that's working for you. The more successful you are, the more freedom, time freedom that you have for yourself. Because if our business is expanding and growing, all we need is to employ more people. As business owner, yes, employ more people. Let's help the economy. Let's give them more job, right? But for an investor, for an employee rather, or a self-employed, the more successful they have, the less time they have for themselves. Now, for an investor, the more successful you are as an investor, the more time freedom you have for yourself. You have more time for yourself because you're not really trading your time for money. Money is working for you, and it's important we know that if you are working, if you do not find a way to make money, if you don't find a way to make money work for you, you're gonna work for money for like eternity. That's just the bitter truth. If you do not find a way to make money work for you, you're gonna work for money for a long time. That's why we're saying that money is an instrument. It is a servant. You're supposed to send money on an errand. And when this quadrant was established, then when it was in vogue, then it was difficult for you to be an investor. It was very difficult for you to be an investor. Why was it difficult? Because the market, as the stock market, financial market at that time, was for the rich, the HNIs, or the high net worth individuals in the society. But now technology has broken all of that. With your 5,000 naira and 10,000 naira, you can invest and make that money work for you. Let me shock you. If you had invested 100,000 naira in 2014 to buy, let's say, Netflix. Yes, Netflix. Everybody's streaming Netflix. Almost everybody watch Netflix, right? So if you had invested 100,000 naira to buy a stock, of course, it's a fractional investment. of Netflix as at then. That's 2014. Do you know that by now you have nothing less than 14 million naira? By now, 2024. That's just 10 years. In 10 years, 100,000 naira has grown to 14 million. That is the power of investing. Send money to go and work for you. You expend money with the idea or with the intention that you're going to receive more. So that's one of the focus of this webinar, to make you an investor. And that's why I had to use this quadrant. The more success we have as an employee or as a small business owner or as a self-employed, the less time you have yourself. Why? The less time you have for yourself. While for a big business owner, the more time you have, the more successful you are as a business owner or as an investor, the more time you have for yourself. It's such an interesting concept. I think I wish everybody can just get in. Okay. All right. Now the cash flow quadrant summary, I've explained this already in the video. As a business owner, as an investor, you have more advantages than an employee or a self-employed because they allow you to earn money without directly trading time for it. Business owners build systems that work for them, creating scalable and passive income, while investors, they grow wealth by letting their money work for them. In contrast, employees are self-employed individuals rely on their time and effort to earn, which limits income and freedom. Okay, so that's it. Now, the passive income sources, we have mutual funds, we have stocks, we have fixed deposits, we have commercial papers, we have bonds, we have treasury bills. We're going to explain this later on. This is what the focus of this webinar is actually. Now, budget. Budget is very important. Budget is a very, very important subject we have to talk about. Because how do you grow your wealth if you don't have a budget? How can you grow your wealth if you do not have a budget? How can you grow your wealth if you do not have a budget? This budget is a statement that shows your income and expenses for a period of time. You know, the journey of wealth creation starts with budget. We have people that don't have budget and they say they have goals, they want to meet a amount of money in the near future, but they don't have a budget. It is very important. You notice the budget is in red font. So we have to put it in red font so that we highlight the importance of the budget. You know, uh, one of the key traits of budget is that it gives direction to your finances. The money that you are making, where does the money go to? Your budget helps you to do that. It helps in identifying wastages. You know, you spend money anyhow, but with the budget, and helps you to, stop that wastage. It shows you what you can afford and what you can't. This is simple. On the surface level, when you want to buy something based on the salary you're earning, you would think you can afford it. But when you have prepared a budget and oh, I've settled this amount of money for my expenses, I've set this amount of money for my savings, and I've set this amount of money for my investment. It helps you to know what you can afford. And someone comes with an amount, let's say you want to buy a shoe bill of 60,000, and you don't have up to that. The budget still shows you that. And when we say budget, I'm not talking about a mental budget. It has to be something you have written down somewhere, or you have it in a spreadsheet, or you have it somewhere written down. The budget also puts you in charge of your money. You are the one. You have been given charge over your money to tell your money where to go. The budget helps you to achieve your financial goals. That is pretty simple, right? When you say you have goals or you have a dream to have so amount of money in the future and you don't have a budget, how will you achieve your goals without a budget? It tells you where you are and how you can make changes in your decisions. Now, this is the format of a budget: income on one side, the expenses on the other side. Salary, interest income. This is not a one size fits all, just an example for someone earning 200,000 naira salary, and the person pays an annual rent of 600,000 naira. Your rent, you're supposed to divide your rent by 12. You're supposed to be deducting your rent from your monthly salary. But people don't do that. That's one of the financial mistake people make. They don't do that. They don't do that. What they do is that they just pay rent upfront and they forget about it. No, we are supposed to divide your rent by 12, and you deduct this from your monthly salary. That's what you're supposed to do. That's what you're supposed to do. Okay. So we have transportation, 30,000. That's for the month. Groceries, that's the food. 40,000. Utility bill, that's the airtime, data. You know, 20,000. Then black tax. Black tax is the money you give to your family members. The money you give to your family members and the money you give to your people as the black tax. You peg it for a month. Then givings, that if you go to church, pay your tithe, your offering, your pledges, and all that. Then you deduct all your expenses from your income. As you can see, the total expenses for this person is 205,000, while the total income is 328,000. Now, the difference between the income and the expenses are the net. It's what we call net income. That is 123,000. So it is this 123,000 this person is expected to put to use for investment. For investment. You can see budget helps you to do that. It helps you to, you know, put in your money where it's supposed to go. You give direction to your finances. You are the one in charge. You are the one in charge. Remember, if you do not budget your money, somebody will budget it for you. Society will budget it for you. People will come and be asking you for money because you do not know how to budget your money. You do not know how to, to send your money on an errand to go and work for you, to go and bring money for you. You do not know how to do that. So people will always come and you will spend it. Okay. So budgeting is very important. Now, budget has options. These are basic assumptions when you're preparing the budget. Salary. So this person in our case study is making 200,000 naira per month. Definitely that means rent cannot be more than 600,000. If your rent is more than your salary, just stay with your parents. Don't let anybody pressure you anything. If you cannot get an apartment such that your the rent will be 3 months of your salary, anything above that car, don't take it. And still be living with your parents pending when you get a good job, or pending when you develop your high income skills to bring in more money. Now we said the second assumption is that we say your monthly rent should not be more than 1/3 of your salary. What do you mean 1/3 of your salary? It's the same thing we are saying with the first thing on the line. The first line and second line are basically the same thing. It's just the way you look at it. And we said debt. If you want to borrow, we're not saying you should not borrow. You can borrow, but do not borrow more than 1/3 of your salary. Do not borrow more than 1/3 of your salary, which means if you're earning 200,000 naira monthly, yes, Tomiwa, yeah, correct. So if you're earning 200,000 naira monthly, it then means that you should not spend more than 1/3 of 200,000 is like 60,000 thereabouts. It means you should not borrow more than that. That's just it. Your greatest expenses are still in your future. Invest now so that your future self can thank you for it. Your greatest expenses are still in your future. So savings and investing is a priority. Save aggressively and invest aggressively. You know, spending should align with financial goals. A budget will only help you do that. If you don't have a budget, how will you spend in alignment with your financial goals? With a budget, expenses are predictable. You know the kind of expenses that can pop up. You can predict it. You know the kind of money you're gonna be spending. You know things you're gonna be putting your money on. You have needs and wants. Many people, you need something or you want something, but that is not a need. The budget helps you to distinguish between what is necessary and what is not. Then motivation and drive. That's the last one. But budget motivates you. It helps you to strive more. Like this person that is making 200,000, the person can now think, how can I increase my income? What can I do? What skills can I learn, to increase my income? That's what a budget does for you. It gives you that, it compels you to do more, invest in high income skills, learn courses, just be better at what you're doing. Basically, that's what um budget helps you to do. Now, if you don't have a budget, your story may be like this person. This is a case study of someone who had no savings. He was supporting his family members. In few months, he lost his job. When he began to seek financial help from his relatives, his mother asked him, are you saying that after 7 years, for 7 years, he did not see anything? You know, but this person was just trying to help his family then, he was earning money, but he just wanted to support because black tax, it's looking at it as a day, it will look like he's helping his family, which is fine. We're not saying you should not help your family, send them money, but let it be a cap to it. Put your money on an errand. This person failed to put money on an errand. This person failed to budget. This person failed to have an emergency savings. Those three things are key. Financial literacy is very important. These three things are important. One, have an emergency savings account. Two, have a budget. Three, invest. 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 If you don't have enough money to invest, save. But don't save in Kolo, don't save in Esusu, don't save in all those things where your money will lose money. No, don't save. Inflation is around 33% now, 34%. So you can't save in all those things where you just your money. No, no, no. Save in high yield savings accounts. And we're going to talk about those platforms where you can put your money there. You get at least 12%, 13% on those platforms. Save aggressively. Save, save, save. Now, you do not want to be like this. Trust me. You do not want to be like this person. Moving on. Now, this post, I found it on Nairametrics, so I just have to include it. Why most people stay broke and how to avoid it. Number one, they don't have a budget. Number two, they don't have growth plan. They are living paycheck to paycheck. Debt trap. They are ignoring investment. They lack financial literacy. You see that last one, lack of financial literacy. That's exactly what we are trying to address with this session. We're trying to address that lack of financial literacy. This is what we're talking about. Is have a budget. Don't be living paycheck to paycheck. Save. Avoid debt trap. Do not borrow more than 1/3 of your salary. It's as simple as that. Just live within your means. Live with who are you trying to impress? Like seriously, who are you trying to impress? Who are you trying to impress? You know, build your mind, learn. Financial knowledge is key. It's very important in making good financial decisions. Now let's move on to the next slide. Now, optimizing your net income. How do we optimize? We said our net income is the difference between our income and expenses. The difference between your income and expenses is your net income. That is when your expenses, the excess of your income over your expenses, right? So you save and you invest with it. You save first in the high yield account, high yield savings account. then you invest later on. Okay, moving on. Now we're gonna talk about the difference between saving and investing. What is the difference between saving and investing? When you save, you are saving for short term. When you invest for the long term. Short term means 3 months. Long term means at least 1 year. The risk associated to saving, it is low risk because there's no risk on it. It's usually a low risk. There's no risk there. But in investing, you have medium to high risk, but that can be addressed. Return on savings are usually very low. That's why you said you should put your money in a high yield savings account, not in a normal bank account. High yield savings account, you will make at least 12, 13, 14% on your return on your money. For investing, you have the potential for higher returns. You can make at least 50% increase on your investment, 100% increase, 150% increase on your on investing. We'll get to that. Liquidity. What is liquidity? Savings. You can easily access your savings, right? You can just go to the bank and cash it. Even in the high yield savings account, you can just go there and withdraw your money. But for investing, it is not that liquid. It is not that liquid. But that's the idea. You are building you are building your financial discipline. Then we talk about inflation impact. Yeah, inflation. What is inflation? Inflation is the rise in the price of goods and services, right? So for savings, whenever there's an inflation, savings will always lose value. Those people that save, that's why they say savers are losers. Do not save, invest. That's one of the reasons why we're doing this. Invest. Investing can outpace inflation if returns are higher than the inflation rate. That's it. Inflation rate is now in Nigeria is 34%. But when you invest, you can get 50% returns, 100% return, 150% return, 80% return, depending on the kind of investment you're doing. You can get way more investing returns on your investment. Now, the growth potential. What are the growth potential for savings? Is very low, but for investing, you have high growth potential. When we talk about the time horizon for savings, the time is very short. While investing, we're looking at long term. Long term. Now, it's important we distinguish between trading and investing because we also have people that are doing trading, like crypto trading, forex trading. That's not what I'm talking about here. I'm talking about investing for the long term. Because trading, for me, you are basically wasting time. Because the idea of investing is that you do not want to trade your time for money. But trading, you're trading your time for money because you're going to be looking at charts. You'll be reading charts, you'll be looking at candlesticks and all that. People are doing that, it's fine. But if you want to make real money, because over the long term, the market will always go up. The market has been bullish. The stock market has been bullish for many years. It will always go up. But in between those 2, 3 months, it will go down. You see drawbacks. It goes down. If you look at Bitcoin is now going to 100,000. Before Bitcoin was in 30,000. Bitcoin was 30,000, I think 4 or 5 years ago or 7 years ago. If you had invested in Bitcoin then and compared to now, you'll be a millionaire by now. Right? So we're talking about investing long term. So you can see it's the time horizon is for trading short term. You'll be really looking at charts and all that. You have time for yourself, basically. But for investing, it's long term, years, even decades approach. It is trading is time consuming. You have to be there, active. But investing, you don't have to be there. It is passive. It requires low maintenance. The risk level for trading is very high because you are dealing with a volatile market. Imagine someone trying to trade crypto, you know, they are looking at 50 minutes time frame chart, they are reading 40 minutes, 1 hour time frame chart. It's very volatile. But for investing, when you look at it on the long term, it is moderate and low. And the objective of trading is you want quick profit for market fluctuations. But for investing, you want to build wealth through compounding. Now we're going to talk about compounding. in the later session. You want to build real wealth. Now, for you needed skills, you need the deep market knowledge, you need those technical analysis, you need all of those things. But for investing, you just need patience and basic financial literacy, which is what we're doing here. You just need patience and basic financial literacy. That's what. Now, stress level. Hmm. You'll be stressed if you are doing crypto trading, or if you are doing forex trading, you'll be stressed. But if you're investing, your stress level will be low because you're looking at the long term. You're looking at the long term. Remember, I told you if you have invested 100,000 in Netflix, 100,000 in Netflix 10 years ago, that 100,000 naira would be 14 million naira today. Think about it. Just think about it. That 100,000 naira that you invested uh, in 2014 by now would be 14 million naira today. Think about that. Okay. Now, the fintech platform that we say you can put your high yield savings, yeah, your savings, yeah, high yield savings account. These are the ones, I just had to do a little this thing to make it, you know, easy for you. Yes, optimals, calorie wise, Afrinvest, right? You can actually invest. Some of them are stockbrokers. You can invest in bonds. You can invest in treasury bills. You can grow your assets. Basically, you can even invest in the U.S. stock market. Bamboo gives you that access. We're going to talk about that later. I'm just going to give you an overview here. Okay. So just, you can just do research on them and see how you can connect to the market. Now, before we talk about this is the second session is about to start. So I'll just play a short video now, so you can get what we're saying clearly. So let me just present the video before we start. Okay.
Let it set or let it reinvest itself and increase my shares.
Please watch this video. I want you to just relax and watch.
Never made more than $12 an hour. Never earned more than $20,000 a year.
How you doing?
So how could he know something about corporate profits? I had to pry.
So Earl, what's your net worth?
$500,000.
$500,000
Yeah.
from working here.
Working here.
Caption.
That's
Very
amazing.
important.
Over $500,000 net worth on a parking lot wage. Now Mr. Earl had my full attention. How did he do it?
Stop working so hard and let the money work for you.
As the years rolled by, Earl kept saving what seemed like meaningless amounts. He started investing $25 each month into a mutual fund and did that consistently for 15 years. By the late 70s, his net worth was $25,000. He bought stock in blue chips like IBM and Coca-Cola that paid dividends and...
Instead of taking the dividends and parking it, let it set or let it reinvest itself and increase my shares. And the more shares I had, the more dividend I had. Eventually, the more money I had down the road.
He believed in the power for the long haul. Today, Earl's stock portfolio alone is worth more than $500,000. And yes, his house is paid for. And no, he doesn't carry any credit card debt. His net worth was $25,000. He bought stock in blue chips like IBM and Coca-Cola that paid dividends and...
Instead of taking the dividends and parking it, let it set or let it reinvest itself and increase my shares. And the more shares I had, the more dividend I had. Eventually, the more money I had down the road.
He believed in the power of compound interest and stocks for the long haul. Today, Earl's stock portfolio alone is worth more than $500,000. And yes, his house is paid for. And no, he doesn't carry any credit card debt.
Yes, I believe you saw that well. Now this was a parking attendant. Now, if you ask some people, they will tell you that no, investing is only for the rich people. That's a lie. You can invest wherever, whenever you are. You don't have to be wealthy. You don't need to, it's not only for the rich people. You are also rich, come to think about it. And look at this person. This person is just a an attendant. He was able to build his wealth over time. This is what we're talking about. Consistent investment. He talks about mutual funds. We're going to talk about that later. So, what he did, he deployed the eighth wonder of the world. What is the eighth wonder of the world? That is the compounding principle. Who called it the eighth wonder of the world? That it was Albert Einstein. I believe you know the person I'm talking about. He said compounding interest is the eighth wonder of the world because it's just a full concept, which I'm going to explain shortly. So, what is the compounding principle? It's saying what you've been doing over time, it compounds. But let me just use this slide to illustrate. So, compounding is when your money earn interest, and then that interest earn more interest over time. Basically, that's what compounding is all about. Say you put $100 in a savings account, it earns 5% interest per year. After the first year, you have $105. In the second year, you earn interest on that 105, not just the original on 100. Then the cycle repeats and the money grows faster. You know, the money keeps growing like that. It keeps growing. Now, why is compounding so powerful? Yeah, it's a great video. Ayotomiwa. It's a great video. So sorry, just a minute. Okay, yeah. Thank you, Ayomiwa, for that comment. Yeah. So you put $100 in a savings account and it earns 5% interest, just like that. Your money earns more money. It's just like a father having a children, while the children is having their grandchildren. The grandchildren are having their great grandchildren. Do you get that? That's how your money builds over time. It's a beautiful concept. So why is compounding? Why is it so powerful? Because it grows over time. The longer your money stays invested, state, the more it can grow due to compounding. That's what compounding is talking about. That's what makes it powerful because when your money stays there in account for a longer period, the more it grows. You earn interest on your interest. Your initial savings keep earning plus each year. Then the interest adds to your total savings. That's what compounding is talking about. Now, this is a calculator to just show you, to illustrate the power of compounding. Now, if you look at my screen, you will see initial investment. We are saying just invest 10,000 naira every day or every month, not every day, every month for 15 years. If you can invest 10,000 naira every day for 15 years, this is the amount of money you're going to get. You're going to get 10 million naira after 15 years. Isn't that powerful? But naysayers will say, 15 years, we will wait for 15 years. But that's how you plan your retirement. Now, one of the ways you plan your retirement. Or do you want to wait till you're 65 before the federal government retires you? Oh no. It's not everybody, it's not all of us that are waiting till 65 or 60. Some of us are going to retire at 45, even 40 safe. Once we knock 40 like this, we're not doing any work. The money has been deployed already to work for us. In 15 years, we are not going to be talking small money. So this is just to show you the power of compounding. Now this is 10,000 naira. You're putting 10,000 naira in an account. The account is growing at 20% in a year. We have such accounts in Nigeria, like mutual funds. That's money market mutual funds. They are low risk, so you are sure that your account is going to be growing 20% per year. So if you can put 10,000 naira for 15 years, you're getting this. Now let's say you put, instead of putting 10,000 naira, You are putting 100,000 naira every month for 15 years. This is what you're gonna get 109 million. Isn't that amazing? 109 million for putting 100,000 naira just monthly. It's beautiful. I tell you, it is amazing. You want to learn the power of compounding and use it to your advantage. Use it to your advantage. Compounding is so beautiful. Use it. Use it. Now, the key takeaways for compounding is that you have to start saving. Not saving, like investing. The earlier you start investing, the more time your savings have to grow. Be consistent. For you to take advantage of the compounding principle, you have to be doing it regularly. Not that you will do it once and you now stop. No, do it. They call it DCA, dollar cost averaging. That's the word they use. People that invest in stock market knows what I'm talking about. Put money in the stock market or here in a mutual fund account at regular intervals. You can see every month. You'll be putting the money there. Be patient. The compounding takes time, but it leads to big savings on the long run. Now, the conclusion is it is a very simple and powerful way to grow your savings over time. Start early, be consistent, and watch your money grow for you. Okay, now we're going to delve into investment needs. Now, even though investing is the surest, one of the surest ways, there are different ways to build wealth. But one of the surest ways to build wealth in 2025 and beyond. Now, when we say 2025 and beyond, we're not saying you're going to be making grow your wealth in 2025. We're saying that you should continue beyond 2025. Now, one of the investing myths is they say investing is only for the wealthy. No, you don't need a lot of money to invest. Look at the video we just watched. That person was an attendant. He was making $25. It's not a big thing. You don't need big money. In your small money that you're making, just be putting it. Just be putting it. More money you're doing, just be putting it there. It's not for the wealthy alone. Goodness, you are actually it's for you. It's for you. Start now. Start now. That's why we're doing this session, right? So that we can educate people to start investing early. They say the investing is too risky. No. While all investments carry risk, proper diversification can reduce risk. When you diversify, what do we mean by diversifying? We're saying do not put your money in one basket. When you put your money in different asset classes, if one should fail and one should, say it covers up, it matches out, and you can invest in low risk investment. We have categories of investment, which I'm going to talk about later on in the session. We have the low risk investment, medium risk investment, and high risk investment. We're going to talk about those ones in a later session. But this one that you're saying investing is too risky. No, you can put in place strategies, you can put in place system processes to mitigate those risks. The next myth is that they will say you need to be an expert before you start investing. No, you do not need to be an expert. You just need basic financial knowledge. Basic financial knowledge, which you can learn. If you want the basic, I can teach you, but you can learn. It's all over the internet. We really don't have excuse for not making money. You don't have excuse for not making money. Please hear me very well. You don't have excuse again. If it was 30 years ago, 40 years ago, you can say, yes, the rich are the one. No. The internet has made information to be available. I mean, the potential is limitless. The amount of money you can make is limitless. You can make money. You can make it. You just need basic financial. You don't need to be an expert. Okay. Now the next investing means they will tell you that investing is like gambling. No. Gambling, you are trying to, you are not sure, you are trying to say this one will win, you are betting basically. No, investing, you are calculating, it's a calculated process where you can control risk and make informed decisions. We've calculated that this one should fail. then this one will win. And no, if it's a calculated thing, it's not gambling. And the next investment means is those people will tell you you are still young, you have your whole life ahead of you. No, you are not too young. It's, in fact, you're supposed to start as you are young now. Start planning your financial future the moment you turn 18. You should start now. You're not too young. Oh. You're not too young. Don't let anybody deceive you. Now let's talk about the facts. We've addressed the myths. So the fact about investing is compound interest is powerful. We've talked about that. I mean, you saw the video. Compounding is just it's amazing. The earlier you start, diversification reduces risk. That's what I say. You don't just spread your investment or don't invest in one class of assets. Invest in different assets. Over time, they will grow. Watch them grow. Just do a basic. Number three, time in the market beats timing in the market. This is another fact. The longer you stay in the market, the higher your potential of having a higher return.
Hello, I can't hear you. Can you hear me? I can't hear you. Can't hear you. Oh, can you hear me? If you can hear me, please, can you comment?
I can hear
If
you.
you
I
can
can
hear
hear
me,
you. Can
say
you hear
can
me
hear
now?
me. I can hear you now. Because I knew I can hear
Hey,
like 3 minutes back.
3 minutes back. You can't hear me. You couldn't hear me 3 minutes back.
Yeah, like 2 minutes back. 2 minutes back. But now
Oh, okay.
I can hear you now. Welcome, Mr. Alex. How you doing? You can't hear. You can hear me. Mr. Moshood, you can
Hello.
hear me.
I can hear you. I can hear. Can you hear me now?
I can hear you.
You can hear me now, right? Can you hear me
Yes,
now? Oh, okay, okay, all right. Sorry about
I
that.
can.
So
I
now
can. I can hear you.
okay, you can hear me now. All right, beautiful. Okay, okay. So yeah, let's just continue. Yeah, sorry about that. Still trying to get used to this. Okay, so yes, you can hear now. Okay,
This is
okay.
the
I think
cost. The
Alex
phone.
said you can hear me now. Okay, okay. I think this is perfect. Now let's just move on. So the facts about investing, we said compound interest is powerful. It's a fact. We've just learned that in the video we just watched now, right? We just saw that in the video we watched now that compound interest is powerful. Now, diversification reduces risk. Spreading your investment across different classes, assets, sectors, and it helps.
Network is
Hello, can you hear me?
I can hear you perfectly. Can you hear me?
Yes, yes, I can hear. Okay, right. So I've removed the mic. I think the mic is acting up. All right. So you can hear me now, right?
I think maybe battery or something.
Can you hear me now?
I can hear you.
You can hear me. Okay. All right. So one of the yeah, okay, right. Great, great, fantastic. So one of the facts about the markets is that the longer you stay in the market, the better your chances of winning in the market, right? So consistent investing over time generally increase returns. Now investing is key to building wealth. Hello, yeah, breaking precious. Now, investing is key to building wealth. Regular investing is one of the most reliable ways to accumulate wealth and achieve your financial goals over the long term. Now, Warren Buffett bought his first stock at age 11. One of the most successful investors in history started young, showing that it is not too late. It is never too early to invest. So start wherever you are. Start now. You know, People will tell you the best time to plant a tree was 20 years ago. Now, the next best time is now. So just start now. Wherever you are, with whatever you have, just start investing. Your future self will thank you for it. Okay, yeah. So let me just rerun this again. Now we're talking about investment types. We have them according to their returns level. We have fixed income instruments, variable income instruments. Now the fixed income instrument, the returns based on the word fixed income, it means it's for a fixed period. The returns are predictable. You know what you're going to get. Now they usually offer lower risk and return. Treasury bills, commercial papers, bonds. I'm going to explain that those ones later. And the variable income instruments are those investments they fluctuate. Their returns fluctuate based on market forces. For example, the the stock market we mentioned earlier. Now, Orlando was worth 890,000 as at that time. If you check it now, it may be another figure because the forces of demand and supply, they are the one controlling the price and they are the one controlling the value in the stock market. Now, it provides greater risk and returns. What do we mean by provides risk, greater risk and return? It means that it is the risk is slightly higher than your fixed income instrument. Investors can hold as long as they want. Now, if you buy a stock, you can hold it for 10 years, 15 years, 20 years, as long as you want. So long as this company is still existing, you can hold it for that long. Now, we're looking at investment types according to their risk level. You have low risk, medium risk, high risk. What are the low risk? That's the high yield savings accounts I mentioned the other time. If you could remember, I talked about high yield savings account. They are low risk. They give you at least 12%, 13%, 14%. When you look through those fintechs platform I highlighted previously, you can get higher interest on your money. Then fixed deposits are considered low too. Fixed deposits are those deposits you do with your commercial banks. Just put money there and they give you an interest on it. They give you 13, 14, 15% rate interest rate on it, and you make money from that. They are low risk, right? Then money market mutual funds. Now this one too is a low risk. They What is a mutual fund? A mutual fund is an investment vehicle such that it is managed by professionals. They pull money from different people. Your 5,000, somebody else 10,000, another person 1 million, another person 50 million, another person 30 million. They pull them together and invest it in the money market. What are those things they invest in money market? Treasury bills, bonds, commercial papers. These are the things the money market the fund managers do. They invest them. They are professional fund managers. You are not doing anything. You are just giving them. They are the one that will invest for you and they will give you a return on investment. They are low risk because they are investing in they are investing in the money markets that are considered low risk because treasury bills are low risk. I'm going to explain that later. Now, okay, we're in T-bills. T-bills are treasury bills. What are treasury bills? Treasury bills are those instruments by the federal government. They use them to, mop up money from the mop out money from the economy, right? We say we want to do projects, we want to finance projects, so we use T-bills to finance this project. So you collect money from the general public and you give them interest on it. You have 90 days T-bills, 180 days T-bills, 360 T-bills, and they are generally considered low risk. Why do we say they are low risk? Because from the government cannot owe you money without paying you back. No, they will pay, right? They are not companies. Companies can fold up, but a nation cannot fold up. A nation is considered sovereign, it cannot fold up, so they are considered low risk. Government bonds is also the same thing, just that government bonds it's a longer period. It's for 1 year and above, 2 years, 3 years. So they borrow money from the members of the public. Now, T-bills is managed by Central Bank of Nigeria. I think that's very different. T-bills is managed by the Central Bank of Nigeria, which is also an arm of the federal government, while government bonds are managed by the Debt Management Office, which is also, an arm of the federal government, right? So bonds are low risk because they are government. Government cannot carry your money away. They will always pay your money. Now, another low risk investment is gold. If you invest in gold, like real gold now, you know, you will get your money. You will get your returns. And people that invest in low risk are usually called risk averse. People that do not like risk. Risk averse, a person called risk averse, someone that doesn't take high risk, just moderate risk. So you just want to understand your risk appetite, and so are you a risk averse person? Because there are in three categories. We have risk averse, we have risk lover, and we have risk neutral. So here, low risk are for risk averse people that don't really like risk. The medium risk is stocks, ETFs, REITs, commercial papers. What are stocks? Stocks are shares. In Nigeria, we call them shares, but in US and UK, we call them stocks. Shares are just a unit of an ownership of a company. These are shares, capital of a company, just a single unit fraction is of the company. So I'm sure you have been seeing GT Bank shares, you've been seeing um Fidelity Bank. Banks are now calling members of the public for subscription for their share capital so that they can increase their capital base as required by CBN. You Stocks are those things. What do stocks do for you as an investor? They are interested in stocks for primarily two reasons. Number one, capital appreciation, and number two, for dividend payment. When you buy a stock at 15 naira today, you expect that stock to grow over time to 100 naira, 150, 200. That is the reason why you are holding the stock. So that is capital appreciation. Now, dividend payment is when every month, every year, or twice a year, the company pays out from the profits the company is making. They distribute at the management's discretion, of course, because the company can choose not to distribute dividends to its company, but to the shareholders. But then you have that option, to collect dividends from your stocks. Now I'm just summarizing. These things they are deep. So, but that's just a quick summary of what stocks are. And ETFs are called exchange traded funds. Just think about they're just a basket of or a pool of funds from different sorry, 1 minute. Okay, just a pool of funds from different companies. Talk about the S&P 500. What is S&P 500? They are just shares. So instead of being investing in one company, S&P 500 is the combination of the 500 largest company in US. So you are not investing in one company, you are investing in 500 companies. We have we have other ETFs like that. They are low risk. They are low to medium risk. We have some ETFs that are low risk. We have ETFs that are medium risk. REIT stands for real estate investment trusts, real estate funds, basically, to invest in REITs. Instead of you to invest in real estate like directly, you can invest in companies that do real estate and they pay you dividends from their stock and their capital appreciations to really make money from them. Commercial papers are with companies. Now we talk about T bills and bonds as a way of countries raising money, right? Commercial papers are basically companies. They use commercial papers are instruments used by companies to raise money from members of from members of the public, right? You know, companies would rather go for commercial papers. Why do companies go for commercial papers instead of loan? If you want to get a loan from the bank, they will charge you nothing less than 30%. Why? Because MPR has been increased. MPR is monetary price rate. It's around 28%. And bank will also want to make money, so they will add their own spread. So you get nothing less than 30% from banks. They won't want to go to banks for loan because then they will get higher rate there. So commercial papers helps them because if you're raising funds through commercial papers, the rate is usually between 24, 25%, 27%. They can still go for those ones because it's not from banks, it's from just individuals in the society. Commercial papers are generally considered to be medium or high risk, depending on the nature of the business, depending on the credit rating of the business. So that's that. Then high risk, your crypto, forex, those ones are high risk. They are high risk. Now, understanding your risk appetite, you want to know whether you're a risk averse. If risk averse is someone that avoids risk, risk neutral, you don't take, you are just in between. Why a risk averse is someone that goes for risk directly. Now, the four elements. I was supposed to spend time here, but let me just rephrase this and 4 elements is talking about wealth. When we talk about the 4 elements of wealth, when we talk about wealth, people generally think we're talking about financial wealth, but financial wealth is just a part of wealth. As a person, you have physical wealth, you have mental wealth, if you have millions in your account and you're not in the right state of mind mentally, you will not enjoy that money. I hope you agree with me. If you have plenty money in your account and you are sick, that's the physical wealth, you won't be okay. So the idea behind the 4 elements of wealth is for you to not only put your mind into financial wealth and put your mind across all this wealth, because once you can master each of these um 4 categories of wealth or 4 elements of wealth, you're in a better position to live a life of purpose and live a life that is impactful. Okay. So that's just the summary behind the 4 elements of wealth. Now, your opponent is not your family members, your classmates, your colleagues of 10 years ago. Your opponent is time. Time is really your opponent. That's why I put a quote. Um, this is the person you're actually fighting with. So you want to make time your friend. You don't want to be, not making decisions. Remember, we said invest, start now, take advantage of your time while you are still young. Because when you are old, you will not have time. Okay? That energy that you have now, when you are old, you won't have them again. So basically, we're saying partner with time. Let time be your motivator. Yeah. So I think that's it. Question time. Yeah. So if you have any questions, you can just reach out to me or Mr. Precious. My name is Moshood Folarin. You can reach out to me on LinkedIn, Facebook, on IG. These are the platforms I use: Instagram, Facebook, and IG. Yeah. So I think that's it. Thank you so much for joining, and I hope you had a wonderful. You learned something, at least if not anything, you learned at least one thing. Okay. I think there's a question here. What does ETS stands for again? The example you give on and that listen and the other one. Yes, ETFs, exchange. ETF stands for exchange traded funds. Uh, yes, you're right, Alex. You're right. Yeah, you're right. Yeah. So they are generally low risk because they increase by 10%. Like for this year, they have increased for like more than 10%. They are low, and you are sure that your money is growing. And remember, your money is growing in dollars. If you invest in all these ETFs I mentioned, and it's at S&P 500, the money is growing in dollars, not in naira, right? So, I think I forgot to mention that you should also try to invest in dollars. So, Bamboo is one of those platforms you can use to invest in dollars so that you can grow your wealth. When you invest in dollars, you have a higher advantage. You have more advantage with dollars. So, how do you beat inflation? You beat inflation by investing in assets that have rates of return that are higher than inflation rates. I've just given you the expo now. The inflation rate is around 34% or 35%. So the higher the higher your returns on stocks, basically around 40%, you can get 50, you can get 100%. Some stocks are even making 150%. For example, Nvidia is just a classical example of stocks that are giving huge returns right now. So you want to take advantage of that. Um, any other question?
Moshood, thank you so much. You don't try. Thank you. Thank you.
Yeah,
I need to eat. Please don't question though. If you want
Wow.
to learn about investments, you
Yeah.
can
So
hear
you
me.
can just
It's
reach
not
out to me if
silly.
you have
Okay.
any questions, sir. So yeah, happy to do this. I'm happy. Thank you
Please
for
don't
this. Thank you for the opportunity. I appreciate you. God bless you. Thank you so much.
Please, 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 welcome. If you need it,
All right.
Mr. Moshood, we don't see any financial section, so you can collaborate together, so you can help you push the marketing, like
Sorry, what is?
finance or investment section.
Sorry, I didn't get
We
you.
need be holding any, we need be hosting
Financial.
any finance or investment class. Maybe
Well, well, that will depend. That will depend. They're not anytime soon, but you can just reach out to me. They can reach out to me. We can talk about that privately.
okay, no problem,
Yeah.
no problem.
All
Thank
right.
you. Alex Davis
Yeah.
practice from Gambia. He's beating. He's actually from Gambia. No problem.
Oh, okay.
Thank you so much for your thank you.
Thank you too. Thank you too for the opportunity to share. I appreciate.
Thank you so much. And need to broadcast to Mark. Yeah. Hey, hey, can you please just say thank you? Can you say thank you, sir? Thank you, sir. Thank you, sir. And
So
show,
I'm leaving
and
now.
show, this is like a course. Yeah, no problem. So you can exist. I really appreciate you. Thank you so much. You can exist. I really appreciate you so much. Make sure you all guys